Hello and welcome to the Australian's Money Puzzle podcast. I'm James Kirby, the wealth editor at the Australian. Welcome aboard, everybody. Now, recently on the show, I had on the Thursday show where we talk about all things investment. I had Sam Wiley on the show, Dr. Sam Wiley. He was an educator, if you remember, very popular on the show. And I thought, really, for the Tuesday show, I should do something similar and find somebody in a similar position who's an educator in that space. So my guest today is PK Gupta, and he is a well-known person in the property market, a property expert for some years now, and also is an educator in the space and runs courses and that sort of thing. How are you, PK?
Very well, thanks, James. Yourself?
Good, nice to have you on. And nice to have, always an interesting time to talk to you. I know you've got your finger in a lot of pies. And you're very active in the market yourself, personally, I know, so it should be good to talk to you in very a line of inquiry that we could pick up. But for me, I think when people think of you or hear of you, often they hear this notion, this concept, some might say promise, of passive investing. And passive investing has become better known now in recent years because of ETFs, which are so popular now, and the people realize you can just actually, there are things you can sit back and let it happen if you like, investing wise. I don't think that's ever the case in property. But tell me what you mean by passive investing.
Sure. Yeah, I think, it depends really what we'd like to discuss. There's passive investing and then there's passive income investing. I think the notion, let's go with the first one, passive investing, the notion that real estate is never really a set and forget type of asset class is very much true. I don't think you can acquire a portfolio of 2, 3, 4, 5, 6, however many properties and expect one day to be sitting on the beach and never have to worry about them all and just magically, the dividends or the rents are arriving in your bank account. I don't think it works quite like that. But I think neither is at the opposite extreme of the scale or the spectrum. So I think a lot of people often, especially in the media, is touted that, the tenants have trashed the place or there's been a flood and et cetera, a million and one horror stories. And of course, those are true and that does happen. But it's really few and far between and quite the exception rather than the rule. So I think passive investing is really about buying good solid assets with good solid bones. If you really don't want to add any value, then you don't have to, as long as you've done the due diligence on the way in, using a good solid property manager that's trustworthy, knows what they're doing. And in that way, it's a contentious topic these days, but let me say it anyway, then you can build a 5 to 10 property portfolio and it really doesn't take more than 2 or 3 hours a month to manage. Of course, I'd be lying if I said that every 4 to 6 to 8 years there's not significant issues that may come up, like a hot water cylinder or a leaking roof that needs a tradie out, things like that. But once again, the property manager can do that work for you, gives you a few quotes, and you simply pay the bill. I'm not sure if that's what you intended by the question, but hopefully that helps.
Yeah. And okay, well, I will leave that there untouched, uncriticized for the moment. And tell me what you mean by passive income then.
Sure. And I think this is perhaps a more interesting topic as well, James, because perhaps a lot of your audience, even my audience, are Sydney and Melbourne based. And when you buy an investment property in Sydney or Melbourne, I don't think anyone can hand on heart and say that's going to give you a passive income, because let's be honest, the market there generally yields in both those cities 2 to 4% up and down, of course. And so how is it that property can give passive income in this day and age? You read all those books from the 90s, 80s, etc. But I still firmly believe it works. However, it takes a little bit longer and you need to be a little bit more, or have a bit more dexterity in your strategy. So the way that, in a nutshell, not to go on, but I don't think it's any secret. You buy good cash flow properties that almost pay for themselves. Let's say 2 or 3 years ago were paying for themselves with lower rates. Right now might be costing you a bit. You accumulate the number of properties in the right locations with a yield of, let's say, 5 to 6 to 7%. And we're not talking mining towns here, talking capital cities or large major regional centers. And it's just a waiting game. Everyone knows what happens to real estate over the long term and in Australia, but that can be, I would say, accelerated if you use the right data. Happy to go into that as well. And then over the long term, 10, 20 years from now, as you've started to pay some of those properties off, or even if you've just stayed on interest only, and let's say a lot of them have doubled in value or even more or even less, then you can sell half your portfolio, let's say, and take the profits. Of course, there's tax implications, etc., and use those gains to pay off the debt of the remaining properties. So let's say you started with 6, after 10, 20 years, you sell 3, and you use the profits after CGT to pay off the debt of the remaining 3 that you hold. And those 3 assets are now unencumbered, and that's really where the passive income story kicks in. It's not really on the way so much, because we all know real estate in a moment in time in Australia is not really a fantastically yielding asset class, but it is the asset class that generally outperforms the others, especially if you include leverage from a growth perspective for the everyday person. So that's sort of my thesis on that one, James.
Okay. I mean, just in terms of just zoning in on something, one thing you did say was, I don't know what the yields were once upon a time, but I presume they were better than they are now. And in the big cities, they are too. Let's call it 3%, right? Is the yield, and you're borrowing at 6, and inflation is 4, and really there is no income worth talking about in the first year anyway from those properties, or perhaps later. So it means to me, to fulfill, even to try and justify the concept you've laid out, which is almost like a lifelong program, isn't it, really, being realistic?
It definitely is. It definitely is not a get-rich-quick type of thing.
Yeah, but even assuming you do it step by step, it means you're not buying in the middle of the big cities. To get those yields, you couldn't.
Generally not buying at all in Melbourne and Sydney anymore. And just to go back a little bit, yields used to be higher. I mean, not that I'm 60 years old or anything, but we can use data to see what history was. Yields used to be touching 10% in a lot of capital cities once upon a time, but then interest rates were higher as well back in the 80s and 90s. So it all comes out in the wash. But if you're looking at capital cities, let's say Adelaide, let's say Perth, let's say Brisbane, large regional centres, Bendigo, Toowoomba, Mount Gambier, etc., then, well, 2 things I just want to say. First of all, the yields in these areas are well above 5%. So yes, granted, they're not going to be putting thousands of dollars in your pocket from day dot, but once again, it's a long-term strategy. And the second thing is these areas, perhaps somewhat surprisingly, grow just as well as Sydney or Melbourne over the long term. And just a quick example is a little old place like Launceston in Tassie. Over the last 35 years, it's grown just as well as Sydney. So you're not sacrificing growth just to chase yield.
I didn't know that. That's very interesting. Okay, so let's say I go with you, and let's say I expect, again, that being realistic, you've got to be, I don't know, you want a 20, 25-year time horizon here, I would think. So you can't be hitting into this at 60. I don't think so. But unless you are a different type of person than most people are when they look at that age, and in terms of their risk and their willingness and their longevity expectations, etc. But so let's say I take everything on board. Let's say I like the concept. Let's say I really want to examine it, and I am prepared to do the work. Just to zone in on the work, 2 or 3 hours. I don't know about that. I at one stage I had 3 apartments, and it seemed to me like it was every other day. I don't know why. It also seemed to me that if an apartment was quiet for a year, then the following year there was going to be twice as much trouble as the previous year. It was like there was no such thing as if there was a quiet period, then you pay for it later. So maybe 2 or 3 hours for you, but being realistic, what should people think of? And are there programs people can buy to manage more than one property? Because I never had a proper program when I was doing it.
Yeah, no, I don't have a proper program either. I mean, I'd love to say, here's my app or whatever, but
off the shelf Yeah,
I'm kind of old school. I use Excel to, I have an investment banking background, so I like Excel. I just use that to manage my properties. But just to delve into that, in terms of the time aspect, of course, the process of buying a property is not simply 2 or 3 hours. It's, I like to say it's generally 3 to 5 hours over 1 or 2 months, 3 to 5 hours a week, that is, over 1 or 2 months. But then once you have that asset, I'll give you an example. And of course, not intending to cherry pick examples, but I have a fairly large portfolio and just sort of the run-of-the-mill average type of properties in Ferny Hills. It's a high-set sort of 1970s kind of post-war type house in Brisbane. It's on a bit of a slope as well, which was a mistake that I made, and it has a bit of a drainage problem. Now, I would say in the first 2 or 3 years, it required a little bit more maintenance, maybe $4,000 or $5,000 a year in maintenance. I had to get some trees cut and fix the drainage problem and do a bit of a cosmetic renovation. And it's an old house, mind you, and it's not brick either. So some of the mistakes that I made. But since that time, I mean, it's cost about $2,000, $2,000 or $2,500 per annum in maintenance. And the property manager, bless her, she's done all that work for me. Of course, it's never nice to get that email from the property manager saying, oh, there's leaves stuck in the gutter, that's going to tenant is complaining. It's never nice to receive that. But when I receive something like that once every 3 months, and yes, it costs money, but I don't need to put any time into it. The manager takes care of it for me. And in the meantime, that property is more than doubled and giving me a good income now. So I sort of think it's quite worthwhile.
How do you choose the property managers? Again, at one stage, I remember I had 3 different property managers, and a lot hinged on the nature of that property manager. Some of them were so good, and some of them were really silly and time wasters for me, and almost irritating in that you were being contacted about very little. And I had always thought a property manager managed it, that I had to manage the property manager. It's kind of the nightmare scenario, isn't it? So how do you choose them? And do you have is it the one group that you use across the country, or do you have different people?
No, I mean, it's a local property manager for every property in different cities and different states that we have. And I think, like, I can empathize with that because I've been through that as well, James. When you land a not so great property manager, it sort of puts you off investing because everything rides on them. I mean, they're like your CEO for that property, and you're the founder or the shareholder or whatever the case may be, so to speak. And I found that, I mean, I don't want to cast any stereotypes here, but the best property managers are those who are investors themselves. They've been in the game for 10, 20 years. They're not just, fresh out of TAFE or fresh out of uni in their early 20s, making 60 grand, not really caring. And the most annoying thing is a nonchalant property manager who sort of says, oh yeah, the tenant hasn't been paying for 2 months. Sorry, I forgot to tell you. Like that's not what you want, right?
No, I never had that.
Like anything, how do you find an accountant? How do you find a good broker? They exist. You just have to know how to find them. And one way is just to check if they've done it themselves, if they're investors themselves.
Okay, right. And okay, good tip. Actually, talking about tips and lessons, one of the things I saw you talk about at one stage was about buyers advocates who have become quite baked into the system now, especially if you're an investor. I mean, if I'm going to go and buy a property in Toowoomba where I have never been, well, I'm going to use a buyer's advocate to help me find the property, choose the property, who knows the town, who knows where it works and where it doesn't work. But there is a cost, isn't there? A considerable cost in using them. So what's your view on them as a cost?
What a leading question, James. No, thank you for asking it.
You're welcome. It's like a parliamentary question, a Dorothy Dixer. Yeah.
No, it's obviously I'm very outspoken on this, but I genuinely believe in this. Look, I mean, I can just share my example. Right. When I first started investing in real estate, I was living in Sydney at the time. I was a fresh graduate working in the city in financial services, and I only had a little bit of deposit. And so I was looking around, where can I buy it? And I found this place using sort of my data techniques back in 2011 of East Gosford. And I was working 90 hours a week at JP Morgan. I didn't have any time to do anything really. And buyer's advocates or agents weren't really like a big thing back then. So I was like, how am I going to like just get enough time to go and drive up to the Central Coast and inspect properties and things like that? I was working weekends. And so one day I found a local property manager up there just on the internet. And I called them and I was like, look, I don't even know if I'm allowed to ask you this, but could you please inspect this property that I'm about to make an offer on? I've done all my due diligence, like flood mapping and main road not, there's 30 factors. I did all that online, but I don't want to buy something sight unseen. And the lady, she was like, oh, I've never been asked that before, but yeah, I don't see why not. And I was like, oh, well, that worked. And she was lovely. And she inspected a number of properties for me. And she was on the ground. She was a local. She had been managing properties in that sort of Central Coast area for more than a decade. And it was a terrific transaction and it's worked out really well for me. And then I just repeated that till now, across 12 properties. And then around 2014, 15, the buyer's advocate world, the buyer's agent world really started to explode. They went from, I don't know, I'm just making numbers up, from maybe 100 buyer's advocates nationally to now like 4,000. And their whole sales pitch, and I love all the buyer advocates listening to this, so please don't take offense, but the sales pitch was, we'll do the inspections for you because you're interstate or you're remote, you can't do them, and we'll find the best location for you. And I just thought back to my own experience. I found the location using data. Data speaks volumes. And the boots on the ground due diligence was done by my property managers, the housing commission nearby, et cetera, vacancy, tenant appeal. And so I thought, like, these guys, I mean, there's definitely a market for them. And for someone who has no interest in learning and not even 3 to 5 hours a week over 1 or 2 months to learn and implement, then I think buyer advocates are useful. But I think if the spiel is, we do a better job at finding locations or we do a better job at due diligence on the ground, then just from my own experience, I can't speak for others, but from my experience, I don't buy that.
Do you buy at auction?
I've never bought at auction, and that's probably that's a good thing you raised. That's probably one exception to the rule. There's definitely a sense of experience and what weight that holds. But when you're investing in real estate, especially the thesis that I and my community have, we're not buying in auction predominated cities or states where it's super hot and you're bidding against emotional owner occupiers and things like that.
Okay, you keep well away from that. Okay, and obviously rationally, I could see how it makes sense. All right, before we go to the break, I want to ask you about one other thing. It would always be an issue that the notion of building a portfolio of properties, an investment portfolio of properties with a lifelong or a decade, 2-decade long plan, hinged on a number of things happening, and in our market, it has to be to some extent underpinned by the tax structures around that. And you mentioned them yourself, capital gains, and we assume there's a capital gains discount of 50% after a year. We assume there's negative gearing. I presume that's baked into all your assumptions. Isn't that something is that a risk you just carry because it's always under threat, and politically it's under threat again? Negative gearing would seem to be under threat. Nobody can believe what they say anymore. They say it's not under threat, but we can't believe them now, right? Because they said they wouldn't change the tax system, and they did. So we can't believe them.
We can't believe them. I think, I didn't make up this quote. I don't want to take credit for it, but the future tax policy, economic strength of the country globally, it's like predicting the weather. I don't think anyone can really do that accurately, but it doesn't mean you don't go to work. You just take an umbrella. You still invest, but you do it prudently. Look, I think negative gearing, my humble opinion, is something needs to happen, something must happen, something has to happen. And you won't often get people who are property, quote unquote, professionals say that, but that's my genuine thought, because there's been study after study after study that's been done, including by the RBA, Grattan Institute, etc., that have said that home ownership levels will rise by 5 percentage points to up to about 72.5% if negative gearing is abolished and things like that. So who as a who as a common and decent citizen can say that that's not a good thing? Obviously, higher home ownership is always a good thing.
Yeah.
So my thesis is actually, I'm actually a big favor of change in negative gearing, and I talk about this on my YouTube channel a lot. The Grattan Institute also found that the top 10% of income earners got about 50% of the benefits of negative gearing. And so if you're struggling to land your first home, statistics like that really make your blood boil. But on the flip side of that as well, the majority of people who do negatively gear, the majority of them earn less than 80K.
Yes.
So it's not just that property investing and negative gearing is benefiting the oligarchs and moguls and all the rich people in Australia. So I think there needs to be a nuanced approach to
Okay.
this.
Okay, but you see it as inevitable by the sounds of it.
Yeah.
Yeah. All right. Okay. Yeah. Very
So
interesting.
one more thing, if you don't mind, James, I also should say as well that real estate health in Australia isn't presupposed or predisposed on this tax policy of CGT discounts or negative gearing, and there's various ways to prove that as well. Especially, they've repealed it once before, and it's not like house prices went back 10, 15, 20%. They didn't. So I don't think house prices all of a sudden going to become affordable. RBA did a research report that said that they would fall between 1% and 2%. So that's not exactly,
Yeah.
huge from an investment thesis perspective. And my firm opinion, maybe unpopular, is that tax policy alone doesn't create a inflating asset class. Otherwise, the ASX, you can also negatively gear in that, write off your losses, and that would be overinflated versus global indices.
Very true. The one that everyone forgets, as everyone thinks negative gearing is a property thing, it's actually an investment thing, and you can negatively gear shares. But very few people are willing to do so, even though you can come up with some pretty compelling numbers on dividend yields, etc., folks. Okay, we will take a short break. We'll be back in a moment. Hello, welcome back to the Australians Money Puzzle podcast. I'm James Kirby, the wealth editor at the Australian, and I'm talking with PK Gupta on property, all things property. He's a property educator. And I have my first question from Scott, and Scott says, in a previous episode, you discussed why investment property loans have a higher interest rate than owner-occupiers. Okay, we've covered that. Wasn't always the case, but it's the case now. In making a loan inquiry lately, the bank salesperson I talked to at a big bank was hinting that if your intention for the loan when you got it was to be an owner-occupier, what you do once you have the loan is your business. Is that right? Whoosh, Scott. What's the name of the bank? What is the name of the salesperson, pray tell, that told you that? That is so close to the line. I don't know if that's illegal. It's got to be damn close to it. Absolutely dangerous thing to say to somebody. Here's the legal position. I asked financial advisor James Gerard, who you know was a regular guest on the show, what's the story? You can go in and say, if you think it's really smart to go into the bank and say, hey, this is for owner occupier, and what I'll do is I'll just go and rent it, and no one's going to know. In the documentation that you sign with the bank that this person is in, the documentation says if you change your intended use at any stage of the property that's linked with the loan, you have to tell the bank. That's in the documentation. If you don't do it, you break the law, you're in big trouble, and you'll have long forgotten who it was who mentioned this hint to you. So none of this is advice. It's never personal. This is general information only. But to Scott and to all the Scots in the world who've ever been told that, I'd be very, very careful. And I think once you know what I've just told you, it would change any plans you might have. Have you come across that one before, PK?
Oh, look, I think that's a slippery slope there. I think it's best to just be honest with the bank when you're applying for a loan or even after you got it.
Yeah. I mean, it comes into everyone's mind. Everyone, everywhere. And half the questions, might I say, or at least a substantial proportion of the questions we get on property each week, behind it all is someone trying to play around with the home and the negative gearing and the investment. You see it in the next two questions. A question from Chris. I'd like to buy a house and can just about afford it, but only if I don't live in it. If I buy a house and rent it out for a few years, can I negatively gear it? Yes, you can. What happens when I move into the house in a few years' time, then sell it a few years later? Will it be subject to capital gains tax because I rented it out for a while previously? Yes, it is subject to capital gains tax for the years in which it was an investment property. And when it's reclassified as your permanent residence for tax purposes, then it is no longer subject to CGT. That's how it goes, Chris, and to all the Chris's out there. Did I get that right, PK? Does that sound correct answer to you?
Yeah. That's bang on there, James.
Right. Do you get that? Do you get people coming up with elaborate strategies where this notion of going in and out between the investment property and the home seems to be a preoccupation with lots of people on the show? Is it with your people?
Oh, definitely. Yeah, we have a Facebook group with almost 50,000 people. And I think people ask these questions because perhaps they're, me too, a little bit too shy to ask the accountant because it might be a little bit not fully kosher, or they're not 100% sure if it's the right question to ask. So we get these types of questions all the time. And I don't profess to be a tax expert, but but most of these things are just on the ATO website themselves, pretty black and white.
And to be honest, folks, it's completely understandable, because if you've only got two investments in the world, one is your home and one is your investment property, you're bound to start getting ideas. If you have 100 investments, then you'll be thinking of other things. So it's entirely, absolutely rational to be asking these questions. But the answers, of course, invariably are disappointing. All right, we'll take a short break. Back in one moment with the last question from Michael. Hello, welcome back to the Australians Money Puzzle podcast. I'm James Kirby, the wealth editor of The Australian. I'm with PK Gupta, property expert and educator. And we've been mostly talking about managing more than one property on this particular show with PK. It was very interesting because I'm sure a lot of you aspire to do that sooner or later. It's a different game when you have multiple properties, and it does take a different mindset and a bit of organization and a bit more time, that's for sure. Okay, Michael asks, if I have an investment property which I have paid off and a mortgage on my residence, is it possible to remortgage the investment property? So in effect have no mortgage on my home and have the mortgage on the investment property, so being able to use the interest as a tax deduction. I don't, again, in conceptually, that question from Michael, or all the Michaels out there, I don't see a problem with that. It's just a bit of paperwork, really. How does it sound to you, PK?
Yeah, generally speaking, debt recycling is a similar concept, right? Taking equity out, which of course is a loan from let's say your principal place of residence or what have you, and if you're using it for investment purposes, then that can become a tax write-off, or you can negatively gear that. If that's, I didn't fully follow this question from Michael, but if that's the sort of premise behind which he's following, then that should be possible. But the opposite way round, in which he's trying to reduce the debt on his actual principal place of residence using equity from his investment property. James, what do you think about that? I'm not 100% sure, because then the use of that is not for investment purposes.
I think you'd have to sell the investment property.
I think so.
To unleash the cash. Yeah, to clear the home mortgage. So that might be a scenario among scenarios that a person in that position might examine. But all very interesting. You can see the main thing always, folks, is segregation of the assets, right? So whatever you're up to, the home is the home, and the permanent resident is the place of permanent residence is the home. That can move. You can choose a different house every year if you've got the energy to put all that paperwork through to the ATO. But the main thing is to keep them extremely separate, so from tax purposes they don't fall foul of each other.
And don't cross-collateralize them whatsoever.
Don't cross, there you see, an investment banker has the language. Don't cross-collateralize them. All right, terrific. Thank you, PK. Very good. And thank you very much for coming on the show today.
I appreciate it. It's a pleasure to be here, James.
Great to have you on. We'll have you on again. And thank you, everybody, for listening to today's episode. By the way, folks, love to see some reviews on the Apple Podcast app. If you would like to add some reviews, I'd love to see what you think of the show and support the show. If you would, if you've had a question answered, perhaps you'd like to put that up there, and keep them rolling. And with the emails, do remember the moneypuzzle@theaustralian.com.au for all questions, comments, and observations. Talk to you soon.